Well, let's find out what today's guest contributors think about this latest twist in the subprime mess. On call today, we've got Alan Murray, assistant managing editor at the Wall Street Journal. We've also got Michael Santoli, associate editor at Barron's. They're going to be joining us for the entire hour. Also in the mix, CNBC senior economics reporter Steve Leisman. Also Peter Schiff, president of Euro-Pacific Capital. And we've got Dylan, pretty big group here. So, Alan, I want to start with you. You heard the soundbite. You heard what he had to say. Did he not know there was a problem?
Well, obviously one of two things is going on. Either he's lying or he didn't know that there was a significant problem in these funds. In either case, there's a lot to worry about there.
Scary.
I mean, in the first case, you may be talking about a criminal problem on his part. In the second case, though, and that's what has the market so roiled, how many other problems are there out there that we don't know about? People don't understand the exposure that a lot of these hedge funds have well enough, including the executives of the companies that run them. And that's why the markets are going up and down every day, because they don't have a clear sense of what their exposure is to the problems in the credit markets.
Steve, is this really what it comes down to, just this lack of transparency where people don't know what's going to happen day to day?
I think it actually goes deeper than that, because the trouble is he may not have known, but let's say he did know that he was exposed to this particular market. Because some of these markets are not trading right now, they have no way of knowing what the actual price is. So that's probably really one of the problems, is that some of these derivatives markets that, look, guys got into because they thought it was good paper, and then they end up finding out it's not as good as has been perhaps rated by the rating agencies. They can't price it, so that's why they're freezing it. And they also know that, and this is a sign, by the way, of a lack of liquidity in the market, if they were to move to sell the paper, it would bring the price down itself and exacerbate losses.
But Steve, you know, that's a real problem here, because we've been told for years now that hedge funds and many of the complex derivatives they use make it a more stable market. And the point you just made is, if there's not liquidity, if you can't trade the instruments, that's not the case.
I don't think, Peter, just one second. I don't think Alan is exactly right. I'll say why. Because one of the things that we've had is we've had a widening of risk. It's spread more widely. And that's probably a good thing. If we get out of this, and I'm not saying we will or we won't, without a major money center bank blowing up, then at the end of the day, the system worked. The trouble is that because we spread risk more widely, the information flow is slower than it would have been. Think about this maybe 10 or 15 years ago, or even with LTCM. We knew there were a lot of problems there, and the question was who was related to them. When it comes to, say, this BNP, what we're finding out now is that this subprime paper was in German banks, it was in French banks, it was to a limited extent in Japanese banks. We're still waiting to hear the extent to which it's in European or American-related funds and hedge funds. So it's spread out, which means the information is slower to come in.
Peter, what do you think about that? Do you think that the risk is more spread and therefore perhaps not as bad down the road?
No, it's a disaster, not just down the road, but right now. You know, everybody is sugarcoating this and glossing over it. Look at what President Bush said today. He said all the evidence points to a soft landing in housing. I don't know how he can say that with a straight face. I mean, the evidence points to a crash landing. I mean, this is the Hindenburg. And yeah, you know, we've got all this bad mortgage paper all around the world. How did that happen? It's because we've been running these enormous trade deficits. We've been going on this unprecedented consumption binge, and we've been flooding the world with these worthless subprime mortgages. The world has been recycling their export earnings into our mortgage paper, and now they're finding out that it's not worth the values that they think, that Americans can't pay it back. And, you know, underlying this whole problem is that American real estate prices are not worth what the appraisers say they are. Imagine what's going to happen to this economy when American homeowners come to the same conclusions that the foreign lenders are, that all their home equity, everything that they think they've earned in the last 7 years by living in a home, it's all gone.
To some degree, that's happening.
No, it hasn't happened. People still think their houses...
That's why you have defaults on mortgages.
No, I agree with Peter on that. I agree. I think that there's not been the reckoning that needs to happen to clear markets here.
Michael, what do you think about this? Michael, I want to get you in here because, you know, people have said that, I mean, how much is really the housing sector responsible for the overall economy? How much of an effect could this really have?
Well, obviously could have a tremendous effect. It has not been a net contributor to the economic growth this year, that's for sure. It's been in recession. And what I would point out, too, is the stuff that's gone real bad and the stuff that basically has stopped trading is mostly the 2006 vintage of true garbage subprime securities that were spread around the world. And if you have a situation where basically the system has to absorb really the tail end of the very worst of the housing bubble, then we have a period of time when we're going to have to adjust. And I think it's a net positive that it's a large French bank right now that's actually putting a name and a number on what we've basically had before as shadows. What this market, what the stock market needed after the S&P financials traded down 12% in 2 weeks was actual tangible victims, not rumors. We're getting the victims. It's not the last
remember, our economy, 70+% of our economy is consumption, and consumers are spending housing-related wealth. They're spending adjustable rate mortgages that haven't reset yet.
You're talking about 2005, Peter.
No, I'm talking about everybody.
I think we need to disaggregate this for people a little bit. What's going on in the credit markets is clearly very serious. There is a seizing up of the credit markets. It's spreading beyond subprime. You're seeing it in the corporate lending markets as well. That's very serious. The question that we don't know the answer to is how is that going to affect the stock market? How is that going to affect the real economy?
We know how it's going to be terrible. We don't have to wait for it to happen. And you can see what's going to ultimately happen soon is it's going to affect the dollar. The dollar is going to fall through the floor. Long-term interest rates are going to spike higher. Consumer prices are going to go up a lot higher. And it's just going to make the situation worse.
Real doomsday scenario.
Hey, Peter.
You may be right, but you may be wrong.
Hey, Peter.
Yes.
Hey, Peter. Hey, Peter. It's Dylan. How you doing?
Hey, Dylan, how are you?
Pretty severe opinions you got there, huh?
Well, they've all been right.
Let me ask you a question, Peter.
Yeah.
Have you sold all your assets and are you short the U.S. stock market? Have you sold your home?
Well,
are you answer my question.
I did have my clients in a hedge fund that's up 375% this year.
I'm not saying. Well, was that hedge fund a short? Was that hedge fund
short? It was short mortgage backed. But you know,
No. Answer my question, Peter. You've got severe opinions and they're welcome here, and
yes.
I enjoy hearing them. Have you sold your house?
I don't own a house.
Are you short the dollar?
I rent.
Are you short U.S. stocks?
I rent my house. I'm short the dollar. I'm long gold. I'm long foreign stocks. I don't have a quarter invested in U.S. money. And as a result of that, I have a lot more money today than I had years ago.
You got all these foreign stocks, Peter, but, I mean, at the end of the day, look what happened today. They're getting hit as well by this subprime.
Nothing goes up every day. I mean, I know stocks are going to go down, but ultimately the dollar is going to fall through the floor. And so at least those foreign stocks are going to have real value. I don't know what the dollar is going to be worth tomorrow. It might not be worth anything.
Okay.
You know, we're in a real mess.
The trouble that's going on here, Trish, is that Peter has been more right than wrong, even if his apocalyptic scenario is overboard, following that general tenor of being in Europe versus the U.S., of being short some of these credit instruments, has been a pretty decent play right here, and nothing really will clear until we can answer the question that Peter is essentially posing, even though he's posing it in such a way as a declarative statement. But what Peter, the issue to me here is how bad will it become, and we won't know till the information clears. Michael Santoli is correct. Every little bit we get is down the road there. The trouble is he can't tell us how far we have to go.
Okay, guys, we got to wrap it up right here. Peter, thank you for your insight, doomsday as it is. Michael Santoli, thanks so much. Steve Leisman, of course. Alan Murray, you're going to stick around. We got lots more ahead.